So quickly to look at the introduction part. So options are different from forwards and futures. We know that. Because in forwards and futures, when two parties are getting into an agreement, both the parties have to adhere to the contract. They cannot really default on the agreement, default on the contract. Whereas in case of options, we know that it is giving a right but not the obligation to do something in future, to buy or sell something in future. So it is giving a right, not the obligation. Whereas in forward and futures, both the parties have a commitment. Both of them have to adhere to the contract. Whereas in an option, whosoever holds the option, this person may have the option or this party may have the option. One of the parties out of these two, who is called as the holder of the option, he will get the right whether to exercise that option or expire it. Right? So that is what differentiates an option from the other kinds of derivative contracts. And on the other side, when we are talking about a forward or a future, there is nothing that is paid from one party to the other party on the day zero. There is nothing that is paid from one party to the other party on day zero of the contract, except for margin or collateral, which is more like a security deposit. It's not a cash flow that is paid from one party to the other party. So, we should not consider the margin and the collateral. Whereas in case of option, the party who has taken that right, who is the holder of that option, is explicitly paying an upfront premium to the other party, and it is non-refundable. It's not a security deposit. It's a non-refundable element altogether. So that's what differentiate options position from the forwards and the futures position, right? Now we know that there are two major types of options. So let's say A and B have got into a contract. A is the buyer. A wants to buy something at a future date. B wants to sell something at a future date. And we said in an option, any one of the parties can hold the option, can take the option, and the other party is called as the writer of the option. So here, if A is the owner or the holder of the option, B is called as the writer of the option. If B is called the owner of the option, probably let me look at A as the writer of the option. Now, in a role of the asset, with respect to the asset, A wants to buy the asset in future, B wants to sell the asset in future. Now, if the buyer of the asset takes the option, we call it as a call option. If the seller of the asset takes the option, we call it as a put option. Now, what is the option for him? Because he is acting in the role of a buyer of the asset, he has the right to buy the asset at a future date for a future price. If he really wants to buy it, he will buy for that price. If he thinks, no, it is not worth buying, he can very well back out of the contract. There is no obligation for him to buy from B. Same way, if B has taken the option, we call it as a put option, and this option will give him the right to sell, not the obligation to sell. If he really wants to sell it on that expiration date or on the maturity date, he can sell the asset. If he does not want to sell it, he can very well back out. But in case he wants to sell it, it is obligation of A to buy it. So that is a basic terminology involved in the call option and the put option. And every option, whether it is call or put, there is an expiration date or the maturity date that is specified in the contract. So that is the date on which either the right would be exercised or expired. Similarly, exercise price or strike price talks about the price at which the the option holder can buy or sell the asset on that expiration date. Now this is where two major kinds of options are available. American option, if I say this is today, this is the expiration date. If I can think of exercising any time between these two dates, the option holder will have the right to exercise any time between these two dates. He can think whether he wants to go ahead or exit. Any time between these two dates, those kind of options are called American options. But if the exercising can happen only on the last date, not anywhere in the middle, it can happen only on the expiration date, those kind of options are treated as European option. And because there is only one date on which the exercise or expiry happen, they are comparatively easier to analyze. There are some straightforward models that are available. The traditional Black-Scholes model for option pricing is having more and more applicability to European options only. Now, regarding some important points associated with the call and the put option, it's always that any party who has purchased the call option, he will expect that the stock price will increase, because call option is giving a right to buy an asset at an exercise price. Let's say here in this example, the exercise price is 100. Right, so A and B, let's say, have got into a deal that A will buy something from B at 100 bucks at a future date. Now, if the market price at a future date is 90, obviously A will not buy it from B at 100. He will expire it. He says that in the market it is available at 90. Why should I buy it from you at 100? So he will not exercise that option. But if the market price is, let's say, 105, yes, he can think of exercising that option because he can buy from that option at 100 itself. So generally it is like A will exercise the option only when the market price is above 100. The moment the market price is below 100, he will not exercise it, which means the person who has purchased the call option, he will always expect that the price will increase in future. The same logic if I put in case of a put option, he is selling it at a fixed price and he can decide whether to sell it or not. So if the market price is much lesser than that strike price, that is when the holder of the put option will decide to exercise the option, otherwise he will expire it. And when he is expiring it, you could clearly see that it is the premium amount that is lost. So because to take that option, a $5 premium might have been paid, and because of that payment of that premium, which is non-refundable, if that option is expired, then the purchaser of the call option is losing that much amount. Here also the purchaser of the put option is losing that much of amount. So a general logic is, in case of call option, the holder will always exercise it the moment the stock price is greater than the exercise price. In case of the put option, the holder will always exercise if the stock price is less than the exercise price. So this can be taken as a very general rule, very much applicable in almost all the cases. Then just looking at the positions and the payoffs. As we have said, if I ignore the premium, right? So we are talking about four important positions. This I am calling it as a long call. This I call it as a short call. This is a long put and a short put. Now you see a person who has purchased a call option. Ignore the premium. If I take in the premium, it's just a parallel. Right? So if I ignore the premium, right, until let's say this is the strike price. So if the market price is below the strike price, the option will be expired. if the market price is above the strike price, the difference between the market price and the strike price is going to be the payoff. So the traditional payoff for a long call option is going to be the maximum of stock price at that expiration date minus the strike price, or it would be zero. And the opposite would be the payoff for the short position, because whatever is the buyer's gain, the buyer's gain is the seller's loss and vice versa. So which means it is minus of maximum of st minus k comma 0, which actually works out as minimum of k minus st comma 0. That would be the payoff associated with a short call option. So you could see that it is a mirror reflection. So even if even if the premium is considered, I will take it as exactly a mirror reflection on the x-axis to that of the long call position. Similarly, when I look at the short long put position, if the market price is greater than the strike price, the holder of the put option, he will prefer selling it at the market price itself. Only when the market price goes below, he will try to sell it at the strike price itself, because he already has an option to sell it at a strike price. So that is where he is getting a gain, which is the difference between the strike price and the market price. So that is where we are saying the payoff associated with a long put option is the maximum of strike price minus the spot price comma 0. And if it is a short position, which is exactly the opposite of the long position, which comes out to minus maximum of k minus st comma 0, which will turn out to minimum of st minus k comma 0. So if I really look at a few more things, this party will expect the stock price to go up. A person who has taken long call will expect the stock price to go up. A person who has taken the long put will expect the stock price to go down in the future. So here it becomes opposite. A short call expects that it will go down, and short put will expect that the price of the option or the stock price or the price of the asset is going to go up in future. So for every option, you have a long position as well as a short. Long is who is taking the option, paying the premium to the other party, who has the option to either exercise or expire the option. Whereas the short is a person who has sold the option, for who is taking the premium and for whom it is obligation to perform in case the long position wants to exercise the contract. So writer of the option receives the upfront premium, but after that his liabilities could be unlimited. He has to act as per the action of the long position. So writer's profit or loss is always the reverse of the purchaser. So I can always look at the negative of the purchaser's profit or loss position and call it as the writer's loss or profit position. Now, looking at what kind of assets are on what kind of assets the option contracts are available. Today, stock options are there, very much traded on the exchanges, where we could see two major kinds of options, the American and the European. Different kinds of stocks are the underlyings. So each contract, it goes like this. If it is a call option, it gives the holder the right to buy. If it is a put option, it gives the holder right to sell X number of shares at a specified strike price in the future. Similarly, we can have foreign currency options. Right, most currency options today are traded over the counter itself, though we have a few exchanges on which they are traded, but majority of the trading in the foreign currency options goes in the over the counter market. And one contract is to buy or sell X units of foreign currency for a domestic currency. Then we are talking about index options, where the underlying is the stock index. Today they are traded both in the over the counter as well as on different kinds of exchanges. and because you can't deliver an underlying index, in most of the case, in all the cases, the settlement is always in cash, no delivery of the underlying portfolio index component. One major thing that we see as underlying today is options on futures. Almost every exchange which is selling a futures contract, we could see an option on futures, which means it is an option that is given to one party to decide whether he wants to go ahead with the futures contract in the future or not. So the life of the futures option ends a short period of time before the expiration of the trading in the underlying futures. So before the trading ends, there is this option is expiring. So to decide whether to go ahead with the futures contract or not is coming out as an exercise out of this futures option. So in case of call option, if I am exercising it, so I am looking at the gain as the futures price minus the strike price. Whereas in case of put option, when it is exercised, it's exactly the opposite for the holder. Strike price minus the futures price comes out as the gain for the holder. The negative, the opposite of that will go as the loss to the option writer.